Welcome, everyone. All right, as we have folks trickling in, we will try to make sure we see folks in the waiting room, but hopefully we won't leave them waiting for too long. So thanks everyone for joining us today. Before we get started, I did want to note that we will be recording this session, which is why we have turned off your cameras and muted your microphones. But if you have questions for our speakers during the discussion, please feel free to use the chat feature and we'll make sure your question is addressed. And if you're comfortable, you can also unmute yourself and ask questions later on. So today's discussion will also be posted to the Duke Engineering FinTech YouTube channel. And that's where you'll also be able to find previous episodes of our Coffee and Crypto chat. So we are now recording. And so I did want to take just a brief minute to introduce our two speakers. If you haven't joined us before or are not familiar with the folks that we have here today, but today we've got Dr. Jimmie Lenz, and I will let him introduce himself and then introduce Lee Reiners.
Oh, good morning, everybody. You know, I think I need to change this. I haven't worn a tie. I can't even remember how long. Somebody asked me that the other day, but I'm Jimmie Lenz. I run two of the graduate programs here at Duke Engineering School, the Master of Engineering in FinTech and Master of Engineering in Cybersecurity. And I come from about 25 years of experience in finance. And so I'm a little bit different than some of my colleagues here at the school, and very entrenched in the crypto Web3, I guess, world these days, and looking forward to talking with Lee about that. And with that, I will hand it over to Lee.
Well, thank you, Jimmy. Good morning to you. Good morning to everyone, and Happy New Year. I'd imagine we have a few returning viewers with us, so it's good to have you back. My name is Lee Reiners. I'm a lecturing fellow at Duke Law School, as well as the executive director of the Global Financial Markets Center. So my scholarship focuses on financial regulation, financial policy more broadly. But at Duke Law, I teach a course on FinTech law and policy, as well as cryptocurrency law and policy. I have a Coursera course, and I know Jimmy has a Coursera certificate that we'll talk about today. And my Coursera course is FinTech Law and Policy. You can Google it. Duke students can take it and get the certificate for free. And I'm frequently cited, I guess, in the media on FinTech and crypto kind of policy issues. And I always have a lot of fun when I get together with Jimmy.
It is always a lot of fun, and I think it's a very topical time to see a lot of things that are going on right now. This is a cool time to be talking about, I think, this space. And I see already one of the people that's joined us has actually just published a paper with a few co-authors, Sunshine and her co-authors. Got a really nice mention from Vitalik the other day on some of the things that they're doing. So that's kind of a cool thing to see.
Awesome.
So this goes much broader than just, you know, what was happening at the engineering school or law school or any place else. This is school wide, some of the things that are happening right now. So it is really cool to see this and to be able to talk about kind of what we're doing right now. So one of the things that you mentioned, Lee, was the certificate program in Coursera.
Yeah.
For those of you who aren't familiar, we did one of the first, I think, drops for a certificate or diploma last week to the graduates of the Coursera course that I teach on blockchain. And I teach that both in the fall and in the spring semesters, and it is very much a semester long type course. And we did that, I think, for a couple of different reasons. I'm always hearing from students, they have a tough time finding their certificates, or how do they get them and things like that. And so I thought, wow, what if we created an NFT so that you always had access to the certificate, and it would be really easy to share that with employers or other people or anything along those lines. And so, Lee, I know this is an area that you've looked at and you've delved into a little bit, and it's a very different kind of use of NFTs for sure. So what was your thought when you first saw it? I know you and I talked about it, but what was your thought when you first saw it?
I thought, cool. This is awesome. So much of the conversation, Jimmy, as you know, around crypto assets is just speculative in nature, right? Is the price going to go up? What's the trajectory here? But it strikes me that that's obscuring a lot of the genuine innovation and potential use cases that are out there. And I thought, your NFT drop for the Coursera, folks who completed the course was one of those examples of something that was of genuine utility, right? The folks who take the course are going to get the NFT, they have the NFT. They're not, going to sell it, right? They can't sell it. I want to talk about, kind of a little bit about the technical side and how you went about this. So that's what I was really excited about, because it was, I think I posted on LinkedIn. It's like, wow, non-speculative use cases, and big picture, and I think crypto is a bubble right now, and I think a lot of people get mad at me when I say that, because they think that I think crypto and Bitcoin is worth zero and it's going to go away, and I don't believe that. I've never once said that for a second. Look, we've had financial bubbles before, right? We had a .com bubble, and guess what? We still have the internet. We have a mortgage bubble, and we still have mortgage-backed securities, right? So from the wreckage, genuine innovation and use cases will emerge, and it's impossible to predict ex ante what they will be. But rest assured, they will be something, because there's too much talent, energy, investment going on in this space. So there's something there. There's something going on there. I think it's just hard to separate the wheat from the chaff at this point. And so that's why I was like, okay, NFTs. Clearly, we know there's a lot of activity in NFTs. Top Shots, things like that. Again, speculative in nature, but guess what? Art is speculative in nature too, right? So this could have staying power, but NFTs as provenance, right? As showing, ownership, rights to something. I think that is probably one of the things that if I was going to pinpoint what will be the lasting legacy here, I would maybe say, that. So those are my thoughts there. Curious to hear, how you set this up. Let's just say hypothetically, Jimmie, I took your course, I have the NFT, I'm applying for a job, they asked to see my certificate, I send them to OpenSea. What do I do? How do I prove that I own, that I took your course?
Yeah, it's a great question. And I think portability is one of the huge advantages of NFTs. For those of you all who have tried to, you apply for a job and somebody says, oh, I need to see your diploma. I need to see a copy of your diploma. You usually have to call the registrar's office and you have to get a certified copy. And usually you have to do this by mail. You can't even do it by on the internet. Some places you can do it on the internet. A lot of places you still have to do it by mail. And you have to pay for that. And then you have to wait. And it's usually only good for a period of time, 30 days or something like that. And you hope it doesn't get lost in the mail. And honestly, schools don't want to deal with this. This is not a profit center for schools. The $10 or $20 they charge for this, it really is probably to cover their costs, and it probably doesn't even do that. And so the employer's waiting to do a background check, and the potential employee is concerned. Are they going to get it there in time? That kind of thing. And so I kept thinking, how do we solve this problem? And the NFT just seemed like it's so much easier way to do it. And so you can literally give them a link. Somebody can go on there, they can look and see, oh, this was issued by Duke University. We have our own wallet, we have our own site. You can see, that it was transferred from there to another wallet. As Lee mentioned, these are non-transferable tokens. So once you get that token in your wallet, you can't send it someplace else. You can't sell it, you can't trade it. In fact, I've had a couple of students say, oh, I want to move this to another wallet I have and it won't work. It's like, that's what non-transferable means. You can't transfer it. And so I was really lucky because in the course, the whole course of study is around doing things. I work in an engineering school, and engineering schools are really cool because we build things. And so the Coursera course is about building things. We do build a lot of stuff. And so one of the very first things that students build is a virtual wallet. And they use that virtual wallet for a lot of other exercises and a lot of other experiments we do and things like that. And so kind of one of the cool things about doing that is that I can, I have everybody's wallet address. I have their email address, their wallet, their name, all that kind of stuff, because that's the way I grade their assignments. Yes, all of your assignments are graded in Coursera. For those students who haven't done well, you can ask them about that. But everything is done through this virtual wallet that you created. And so I had all their addresses. So it was really easy for me to do the drop to their wallets. And one of the cool things was I didn't tell anybody what was going to happen. I worked with another third-party company called PayMagic just to make sure everything went well, and it looked really cool. And they helped on a lot of that kind of stuff, the creative stuff and some of the development. And PayMagic, one of the other cool things there is it's actually run by two Duke alums, one who was as an alum of the engineering school. Nice. And that's David Iber and Corbin Page. Corbin Page is a graduate of the engineering school. And so I wanted to make sure everything looked well and it went well. And so we just did the drop. And then I sent all the students an email and I said, hey, this is a really cool thing. Why don't you guys take a look at your wallets? And so everybody, dived in and took a look at their wallets, and they're like, wow, I have this NFT there. What is this? And they started opening it up and they saw that was their certificate for the course. So it worked out really, really well. So that's a really long answer, Lee.
No, well, that's what I have more. Well, I have more questions about how it works, right? This is a show about the details. So I think you require everyone to set up a MetaMask wallet. Right, and I think MetaMask stores ERC20 tokens, if I'm not mistaken.
That's correct.
So you create an ERC20 token. You put it to their MetaMask wallet. Now, let's say that they're applying for a job. The employer sees, hey, I saw you take this Coursera course. Can I see the certificate? Where do you point that employer to? How do you point them to? Because I think you made it available on OpenSea.
OpenSea, right? Yeah, it's easy. So, yeah, it's really easy to do it with OpenSea. They can just provide them a link and they can see. Not only can they see the certificate, but they can see the certificate came from the Duke University wallet.
Okay, and
maybe which we've done very nice customizing for Duke.
That's awesome. Well, other folks like me got to jump on board, push that Duke NFT brand, man.
Yeah.
Maybe for folks that aren't familiar watching the recording, Jimmie, maybe just explain OpenSea, what they do, who they are.
Yeah. So OpenSea is another facility, a blockchain facility, and so this kind of leads me in actually two things, Lee, because a lot of people asked about why we did it on how we chose the network and things like that. A lot of people assumed that we would use, because we're using ERC20 tokens, we would use Ethereum, but we didn't. We use Polygon, and Polygon is very easy to access via OpenSea, and you can see everything that all of the transactions that go on, just like you can if we were going to use Etherscan for things on Ethereum. I think when you're doing something like this, when we're thinking about things along these lines, somebody just put it in the chat. When you're thinking through, any kind of solution like this, I mean, I love building things. If people are ever around my house, they'll see I always am building something. And it could be anything. It could be something, like this, in the virtual space, or it could be, a car or something. But I'm always building things. And when you build things, you have to kind of look beyond just the problem at hand. You have to look at the outcomes. And so when we started looking through this, when we started looking at, the outcomes, what's the total picture here of this solution that we're thinking about. One of them is cost. Using Ethereum would have cost us a lot, in gas fees. For any of you who are using Ethereum now, who are familiar with the charges that are now for now being assessed to put any kind of transaction on Ethereum, it's pretty expensive. It's funny, Joe Lubin was one of our speakers at seminar last semester for the FinTech program, and this question was posed to Joe, and his basic answer was, the market will decide, and so people are still paying these fees, and so I guess some people in the market are still good with that, but we decided to go with Polygon Network. So instead of using Ether and Etherscan and things like that to see the transaction, we're using Polygon and OpenSea. And so Polygon on Ethereum to do this NFT drop would have probably been several $1,000s. On Polygon, it was several dollars. So it was a very significant difference in fees, in gas fees, cost, and cost is something, for this to be widespread, Lee, I think, we have to look at that. I actually have a couple of other ideas in the back of my mind that I'm thinking through right now for a more broad-based way for universities to do this and for other schools to do this. But I do think that as we're starting to consider this, as NFTs become utilities like this and carry this kind of information, that we have to look at the whole solution, the whole picture.
Yeah, I agree with that. Certainly, listen, if you're buying a Beeple for $69 million, you're not too concerned about the gas fees.
Yeah.
But if you actually want it to be, useful in the sense that it facilitates transacting, then it's a problem. And so, let 1,000 flowers bloom. Right now, there's all sorts of blockchains, and there's Solana and Polygon. Be curious to hear, Jimmy, what is unique about Polygon that allows for greater throughput? Is it the proof of the consensus mechanism? What's going on there? Because you're right. I mean, crypto. There's been a lot of narratives, and I think the narrative is shifting. I'd like to talk a little bit about that, but the way it's set up now is that it's actually quite cumbersome to use for transactions. One, in just the settlement time, and then in the fees associated with it. So I know there's a lot of innovation, obviously happening at the engineering school to try to make it more useful. But what are your thoughts and suggestions there?
Yeah, Lee, this is so different than most of ours. We agree on everything. I think that, to me, that's one of the biggest concerns I have, but I think it's one of the biggest areas of opportunity, is exactly what you said. I mean, I've used this analogy before, but what put a PC on everybody's desk was, I would argue, Windows 95. It made it really easy. It was a pretty good user interface. It was a great user interface at the time, and it was point and click. I mean, how hard is that? We do not have that on right now in the blockchain space. I would go beyond crypto, beyond DeFi, beyond anything. We don't really have that that kind of user friendly interface, and I think there are a couple of reasons for that. I think it's exploded in popularity, and people who want to be involved will learn how to do things. But I think that what's happening is it's also limiting kind of the some of the creativity, and I think limiting some of the development a little bit. This lack of good user interfaces. Yeah, the coders will still get in there and they'll still do stuff, and we're still teaching that, and we're teaching Solidity and those kinds of things. And I think you always have to do that, right? You always have to have people with those skill sets. But I think broad-based appeal will likely come with better user interfaces. And I think as we do that, then kind of what you alluded to at the very beginning, some of the bubbles that we've seen were not like they popped and everything went away, right? It just led to a consolidation. And I think the same thing will happen here. There'll be some consolidation. We can't have, thousands and thousands of cryptocurrencies and all kinds of things like that out there. There will be some consolidation, and I think some of that will probably happen around user interfaces, more user-friendly interfaces and things along those lines. When you talk to people that are in the space, they'll say, "Oh, well, yeah, but MetaMask has changed this," or Gnosis has changed that. It's like, yeah, but you're still going to, all these different places to do things. There is not an overarching way for people who aren't familiar to come in and do things, and even sometimes people that are familiar, they're kind of I think overwhelmed by some of the things that are going on. And then on top of all that, you have these considerations like gas fees that are overriding kind of everything. And so there again, these are not things that are going to stop. These are all opportunities. I think see these as huge opportunities for people coming out of the engineering school or in the engineering school to actually create those solutions, and other schools, other businesses.
Absolutely. And from an investing standpoint, right? I think they know everything you just said, going back to the dot-com bubble. Okay, you could have, if you had invested in Amazon, everything else in your portfolio, right, could have tanked, could have gone away, and it wouldn't have mattered, right? And so I think that's kind of the psychology, right now amongst VCs and others who are investing heavily in crypto, and that's kind of why we know it's been a bad start to the year for crypto. In fact, it's worst start. It does seem, at least in Bitcoin's case, that there is a resistance level has kind of set in at $40,000. Now, I would be concerned if I were an investor and it cracked that. But the market does not seem to be differentiating between different blockchains and different crypto assets at this point. They generally move in tandem. But yet they do serve different purposes, right? Or at least they're intended to serve different purposes. And I wonder when that will change. When the market will kind of understand and differentiate. Okay, Polygon is different than than Bitcoin. Algorand is different than than Ether. Intended to serve different functions. But right now that differentiation hasn't played out. And I said this on CNBC the other night. I think. This is a tough moment for crypto and Bitcoin in particular, because again, the space has been fueled by narratives from the very beginning. Mm-hmm. And the narrative that has sort of crystallized, at least in my mind, recently, is that crypto is digital gold, and Bitcoin in particular, right? You hear this about Bitcoin all the time, because there's only going to be 21 million ever put into circulation. Therefore, it's a hedge against inflation, evil central banks, right? We know the power of memes in the ecosystem, right? Money printer go burr. We've probably all seen those memes, and yet here we are, Jimmy, and as you know, and I'm sure everyone knows, inflation is as high as it's been in 40 years. Last week, year over year, the consumer price index went up by 7%. Yeah. So these, I'm sure most of the people on this Zoom right now, they've never seen this before in their lifetime. And yet, crypto is tanking, right? Crypto is not performing well, and so that thesis, there's a hole in it, a very big hole. And so, what is the narrative now that's going to propel, future returns if it is going to happen? And that's why you see more people, more crypto backers, really pushing this whole Web 3.0 narrative. That I'm, you know me, Jimmy, I'm a skeptic by nature, right? And so this is another one where I'm like super skeptical of. I'm curious to get your thoughts, but at a high level, right? The story is, listen, Web 2.0. It's walled gardens, right? We're relying on big techs. They have all of our data. We have no power. We, the users, have no power, no control over our data, our information. Well, blockchain changes all that, right? Blockchain, we can reveal what we want to reveal about by ourselves. It's decentralized, power to the people. And of course, to make it all work, you need crypto, right? To kind of, incentivize the network to maintain it. And so that's kind of where things are shifting. And, of course, it's a very self-serving narrative for a lot of people who are pushing this, right? Because if you say that this is the future of the internet, then you would tell policymakers, don't do anything that could disrupt the future. This is inevitable, right? We want this future to occur in the US. We want the jobs, we want the industry here. So don't you dare do anything that could, disrupt this innovation and regulate crypto too aggressively. So we'll see if this takes hold and grows. But I just have some concerns as someone who focuses on kind of financial stability issues and what's going to happen when this thing does bust. How broad will the pain be? Will the average person feel it? Will it affect the financial sector? Will we see, another AIG Lehman type of moment? And you can't rule it out. Honestly, with crypto at this point, you can't rule it out because it's become so integrated with the financial sector. So I threw a lot at you there, Jimmy, but just curious to get your response.
Yeah, so I think you have some valid questions, as you always do, Lee. I think that there are, with respect to cryptocurrencies and some of the other assets, NFTs and things like that, I think we are seeing some changes that are taking place. I think for a long time it was purely speculation, but we're seeing people come in from more of an investment, more of a maybe a medium term, longer term, in particular in some of the NFT assets. Whether you believe in them, whether you don't, whether you like people's art, whether you don't, doesn't really matter. As you said, these are collectibles. They're like art, they're like wine, they're like, vintage cars. There are a lot of things out there that are collectibles. And because people, have imbued this value on those, that's why they hold it. So I think that that has changed a little bit. The cryptocurrencies themselves, I think, are different. I think you do have a lot of market makers out there. You have, I think those markets are becoming more and more electronic. We're starting to see, while we haven't seen a consolidation of exchanges, we are seeing, I think, some consolidations of people in certain exchanges just by usage, not by regulation or anything like that. So I think that's one of the reasons that we're seeing it. People have always said that this was a uncorrelated asset. So to your point about inflation and things like that, maybe this is being proven out. I don't know. The fact that you do see the serial correlation among cryptocurrencies is a little bit strange, but I think that goes to what I was talking about before. But there's a lot of them out there, and so people have a difficult time differentiating between the different types, the more utility oriented versus purely those that are maybe have some kind of a project or something like that they back, or that there's nothing in back of. I do think that there is a huge differentiation, but we're not seeing a lot of people coming out and talking about those or doing research on them or things like that. And so what happens is you do find this serial correlation. You see that in other assets too. You see that in other groups. I mean, why do we talk about the banking sector? Because they, and certainly, I don't think you can compare all banks, but they all trade together pretty much. So maybe it's because we're lazy, maybe because there's a serial correlation of assets. I don't know what the answer is there. But you do tend to, I think, see some of that. I think your point about the broad-based adoption and the amount of value, now we're at $3 trillion. That's nothing to laugh about. $3 trillion is a lot of money. You're seeing a huge increase in the amount of assets that are being placed in DeFi type protocols, right? Lending protocols and things along those lines. So that $3 trillion has been leveraged in a lot of cases. So it's actually much larger than that. Yeah. That's something that people should take note of. I think that, me, I'm a huge believer in rather than, trying to quash innovation, trying to support innovation and to move it forward. I think it's a competitive advantage that the United States has right now, that we have a lot of people building things here. When people look at competitive, the competitive juices around the world and what's going on in different areas, I think that, we've made a very, very different stake in things than, say, China. China has, been very overt about saying we don't want people doing this. And honestly, I think it's going to be to their detriment. You see more and more people getting involved. You see some really interesting projects. You do see Web3 development, and whether you're a huge believer or naysayer, there's a lot of, I think there are a lot of creative influences going into that right now. And so any country that says we don't want to support that, we're going to do everything we can to stop that, I think it's going to be to their detriment at the end of the day. I really do. You were talking about, what is kind of this become? What happens with Web3? I mean, I don't think 20 years ago, any of us would have said, online shopping would have been, what it is today. It has literally changed the face of civilization. I would say, just that aspect of the internet alone. You think of all the bricks and mortar stores that don't exist and companies that don't exist anymore. I'm not saying that Amazon's the be all end all. I'm certainly not saying that. But they've changed the face of civilization. They really have in what's happened. And so I think that this has the same sort of. I think the potential is there. Whether it'll happen or not, I don't know. But I think it has the same kind of potential.
Well, we should be open-minded, and I certainly encourage my students, and it's and it comes naturally at the engineering school, right?
Right.
Like you said, you build things. You are open-minded. You're open to the future, and you make the future. The law school, very different. There's a bit of a self-selection, of course, when it comes to law students. And so, I always tell them, I actually start my crypto class with the evolution of Jamie Dimon and all the kind of negative things he was saying about crypto. And then now all of the things that JP Morgan is doing with blockchain and crypto is evidence of why, we should all be open-minded. It's easy to scoff, of course, at Web3 in the metaverse, right? Which is kind of, I think, the most front and center Web3 application right now. But look, Facebook, you can dismiss it as a marketing ploy. Meta, right? The name to Meta, and maybe an attempt to move on past some of their political issues. But they're putting a lot of money into this, and that's not something that we should ignore or scoff at. I mean, they're investing sums that would lend you to believe that there's something there. There's something real there. And I think when you talk to younger people, and as you do, Jim, you teach them, this separation between the digital and the offline, it's not like it is for us, right? I mean, it's kind of all merged. So it's not far-fetched. I mean, there's concerts, right? There's been a Travis Scott concert, there's been a Justin Bieber concert, in Fortnite, I believe. I know the Travis Scott one was in Fortnite. I don't know what the Justin Bieber one is. So it is quite possible for the metaverse and for Web3 to take hold. I just think competitive and economic forces are such that there's no reason to think that it's just not either going to entrench the existing incumbents, right? We've already talked about Facebook; they're investing big time, or sort of create new, intermediaries that are no better. I mean, I just don't see why we would expect that this future of the internet is going to restore, our rights and our ability to have a say. So that's kind of where I push back up a little bit. In terms of the innovation happening here, of course, I generally agree with you there. I think, as someone, again, my background is financial regulation, what are the risks that are accruing? Because, the innovators, they're not thinking about, okay, what are the financial stability implications, or, how do I control for this, right? And nor should they. It's not their job, but it's someone's job, right? Or it should be someone's job. And, I just have a lot of frustration with how the Fed and other regulators have approached crypto. And frankly, I would characterize their attitude is just, dismissive and hoping it would all go away. And now, here we are, as you said, it's a $3 trillion market. For context, subprime, the start of 2008 was valued at around $1.2 trillion, subprime mortgages. So, we're already at a point where, I think it's probably of systemic significance, and no one has a handle on it, right? And there's no clear way forward. And so, maybe just let me talk a little bit about, what do we mean when we talk about, systemic risk, right? And what we mean is something that could threaten the entire economy, right? That could spill over into the traditional financial system, right? Which effectively is an intermediary, right? Connecting, savers of capital with the users of capital. We need banks, we need investment banks, right? To funnel capital to the economy to help the economy grow. And so when we talk about systemic risk, it's something that could, spill into the financial sector, right? Threaten individual financial institutions. And if that were to happen, then it would have a broad spillover into the economy, just like you saw with 2008. So that's what we're talking about. And so what are the mechanisms by which that could occur, right? Well, one is just, you have something that's of significant size, and if it bursts, you see this broad sell-off in risk assets, and there's this fire sale, right? That's one avenue. Another is something we look at is called, contagion, right? So, interconnections. How is the crypto sector connected to the traditional financial sector? Now, not that long ago, there really wasn't much there. Crypto was kind of over here, and then the traditional financial sector was over here, and there wasn't much linking them. But that has changed, right? And I think, there's some kind of pivotal moments where it did change. One was back in December 2017 when we saw Bitcoin futures enter the market. Now, as of October or November, we have
November probably. I know where you're going. November.
November, we have exchange traded funds that track these Bitcoin futures. Now, of course, one of the holy grail amongst the crypto investors is an ETF that tracks underlying Bitcoin. Now, the SEC has thus far refrained from permitting that, which I know is a point of consternation amongst crypto backers. You mentioned, so we have Wall Street firms that have crypto trading desks, right? We know that there's asset managers that are offering this to their clients. We have the traditional custodians, State Street, Bank of New York Mellon, that are getting into crypto custody. We all know the challenges there associated with the keeping your private keys secure. So, and it's only going to grow. It's only, because, the thing about Wall Street is they don't care about the ideology around Bitcoin and Satoshi's, white paper. If there's money to be made, they're going to get in on the action, right? And they've been kind of on the sidelines for a while and watching everyone else make money, and they're sort of sick of it, right? And so they're jumping in big time. Another thing that contributes to systemic risk, right? Leverage. You touched on leverage. It's growing. Certainly, DeFi facilitates that. And then, overall, this is an opaque market. It's not a well-lit market in the parlance of market regulation. We don't have a lot of visibility. Of course, yes, the blockchain is a way where we can see all the transactions, but we don't know, individual exposures, right? We don't know, leverage. So there are a lot of things that I think should give any, regulator concern here. And there's just not a clear way forward. And to your point, how do you control the risk and address the risk without stifling, truly beneficial, economically beneficial innovation? And it's not easy, and it's never been easy. And I'm a bit of a pessimist at this point, to be honest with you, Jim, on this note, because when you look at the history of financial regulation, generally, when does it occur? It occurs after a crisis.
Always
right?
the rearview mirror.
always the rearview mirror. So we have to ask ourselves, what will this crisis look like that will change the face of FinTech and crypto regulation? And I just hope it's not something that sort of takes the financial sector and all of us with it.
I think it's a valid concern. I do. And I've had the opportunity to speak a couple of times at Duke and DC to legislators, and I think that I've tried to be very upfront about the fact that I think considerations around regulation are certainly valid, I don't think it should be done in a vacuum. Be educated and don't be thinking about stopping. Think about, maybe controlling innovation going forward, but promoting innovation. I don't think driving it offshore is a good idea at all. Remember, this is virtual. There are a lot of investment vehicles that are coming out. Grayscale has a couple of different investment trusts and things like that. They provide you with an opportunity to invest in different sorts of cryptocurrencies, and it is becoming more and more entrenched, as you said, more and more opportunities for people to invest in different ways and get exposure in different ways to cryptocurrency. Some of them are well understood, some of them are less well understood. It will only increase. This isn't going to roll back. And so I would be happy to speak with any legislator who is considering this, and providing what input I can on this. But coming out and just quashing it isn't one. I don't even think it's feasible to try to do that. But it certainly, from a competitive standpoint, is just not a good thing to do at all. As far as contagions and things like that, those are valid concerns. People should look at that. At the current level that we're at, $3 trillion, that would be the second largest exposure that Americans have. The first is mortgage debt. Second is student debt. But this is actually double almost what student debt is. Student debt's about $1.6 trillion. So this is almost double that. And so it is something to take note of for sure. But I think at the same time, you have to take note of it's $3 trillion. This is a lot that it's generated. There is a lot of opportunity there. Let's consider it in that kind of a way. Let's think about it in that kind of a way. You mind if I take a little bit of a left turn here? I wanted to ask you about one other thing. And
let's put.
Okay, go ahead.
Let me make one more point. Let's take one more point, and then
okay,
and then we'll take the left turn. Because you mentioned the opportunity. We all know that the traditional economy, right, it's become sort of winner take all. Right? It's very skewed towards the top. Well, that same dynamic is playing out in crypto, Jimmie. A few weeks ago, the National Bureau of Economic Research came out with a paper and showed that the top 10,000 Bitcoin accounts hold 5 million Bitcoins. So this means that the top Bitcoin holders control a greater share of crypto, of Bitcoin at least, than the most affluent American households control in dollars. You look at where the investment is flowing, right? It's flowing to intermediaries. Remember, the old adage in Gold Rush, sell shovels.
Yeah.
Right? That's what's happening again here. Another data point. Citadel Securities, and some folks might be very familiar with Citadel from the memes. They're rolling the meme stock craze. They do a lot of things. They're automated market makers. One of the things that they do. Well, last week it was announced that Sequoia Capital and Paradigm, which is a crypto-focused investment company, had put in a little over $1 billion in Citadel. Well, that's noticeable because up until now, Citadel hasn't traded crypto. And I think in the release it said that they were getting into crypto. So right. Now you have, automated market maker, an intermediary, getting into crypto. I think it's also telling. When you look at, Robinhood's, annual quarterly report, Robinhood actually collects more payment for order flow on their crypto trades than they do on their stock trades, right? And I think most people are familiar with payment for order flow, right? Why is Robinhood trading commission, zero commission? Because they're selling your order to someone like Citadel. So,
by the way, everybody else does that too.
Oh yeah,
Robinhood's just called out on it.
Yeah, I totally agree. Payment for order flow, but yeah, Robinhood didn't create payment for order flow, and and we don't need. I don't want to get into debate.
Let's don't get into that. Yeah.
I actually, personally, I think I don't really have a major concern with it. I would have to study it more, but I think the benefits of low cost, zero trading, if you're investing for the long term, I think it's a good thing, actually. So, so I would just caution folks who think that they can make, that as an average, retail investor, that sort of crypto and blockchain kind of gives, power to the people, and you can make a buck, and you can put one in over, get one in on Wall Street, because that is just not how it's playing out right now. And I think that gets us back to, listen, these things are, there's some utility here, right? Let's just not think of it in speculative terms, but the investing is happening in the intermediaries. And again, final point here, one of the great ironies, and there's a lot of them when you look at crypto, is that for a technology that was premised on bypassing intermediaries, right? Again, I always go back to the Satoshi white paper. Commerce on the internet has become too reliant on trusted intermediaries. So Bitcoin solves this, peer-to-peer payments. The ecosystem is filled with intermediaries who are making a lot of money, and we've just swapped one set of intermediaries, banks, right, principally banks who are regulated, with another set of intermediaries who are lightly regulated. And again, from a financial stability standpoint, I don't see how we're better off, right? And I don't actually see how crypto investors are better off.
So I think that there are definitely differences, at least right now. But this goes to my point about user interfaces too. I think one of the reasons people defer to third parties is because it is difficult. Often the user interfaces are not great. And I know a lot of my friends out in the crypto space are going to be throwing rocks. No, we've done this, we've done that. It's like, they're still not good. Trust me on this. They're still not good. Nobody's pointing and clicking to do stuff. Even the exchanges, I would say, are not very good. They are, in trying to do any kind of derivatives. And I know there are a couple of places that are starting derivative exchanges and things along those lines. But even simple listed derivatives are not very good. And I'm happy to talk to anybody about why I believe that's the case and what could be done to enhance those a little bit. But I do think that this idea of trying to find a little bit better user interfaces will make a difference, because people can do this. The difference is, if I want to buy a stock, I have to go to a brokerage firm in the United States. There is no other option. If I want to buy a cryptocurrency, I don't have to go to an exchange. I can, but I don't have to. And that's a very, very different type of thing. Even the exchanges themselves, and you and I have talked about this, are very, very different. And they have disintermediated some of the players, not all of them, but some of the players in that process. So I think it is different, but you do find these consolidations, and there are people willing to sell you picks and shovels. There are a lot of people willing to sell you picks and shovels. But that goes, again, as I said, to I think development that needs to occur if people are so inclined. Some of the entities that are becoming more popular in the space, DAOs, for instance, I think they have taken that to that next level, right? Where you have these self-governing organizations that have taken it to a different level. And that's very, very different than what we have in the traditional financial setting. It shouldn't be, but it is. I mean, really, any public company should be considered a DAO, right? But we know they really aren't. So there are those kinds of entities out there. There are those kinds of changes. Your point about consolidation of the wealth, it's a very valid point. In particular, in Bitcoin, there is that consolidation going on. I think when you look at percentages, though, percentages of people and percentages of accounts and things like that, it's not near what we see in the real. I'll call it the real world. It doesn't have near that level of consolidation that we see in the non-virtual. That's what I'm calling the non-virtual world.
There we go.
It seems like that's the that's where we go with that. So at least in my mind, that's the case. I don't know.
I buy it. Okay. All right. What's your left turn?
My left turn, I wanted to mention something that you probably saw that came up very recently, and this kind of goes to your point a little bit. There was a consortium of companies that came out fairly recently, just in the past week, that are looking to launch their own stablecoin. These were, some of them were banks, some of them were quasi-financial companies. And I wanted to see what your thoughts were around that. I know you've had a chance to look at some of those things, but I wanted to see what your thoughts were around the new this new stable coin that was being launched by, as I said, a consortium of banks and quasi financial companies.
Yeah, I mean, I haven't, this time is perfectly with Austin's point in the chat here on stable coins. Haven't had a chance to study the consortium proposal as much as I would like to. It certainly strikes me that stable coins are only going to grow in prominence and significance. They grew tremendously last year. I forget where they started at, but the stable coins in circulation ended the year around 150 billion, I think, in market cap or something like that. So why, right? The question is why is that? SEC Chair Gary Gensler has accurately characterized stablecoins, in my opinion, as casino chips at the casino. So what do stablecoins allow you to do? Well, they allow you to trade on debanked or unbanked exchanges, principally overseas, right? And for those of us who have used a centralized exchange in the U.S., like a Coinbase or a Gemini, we just know how cumbersome it is to go from to link to your bank account, get the fiat in your in your Coinbase account, then trade, right? So if you're trying to move quickly and you're spotting what you think are profitable opportunities in crypto, it's just very hard to take advantage of that if you're relying on fiat. And so stable coins, since they have the properties of crypto, except that they're tied to a fiat currency in most cases, are an attractive alternative. Second, you mentioned DeFi. So stable coins are principally the collateral that underpins so much of DeFi, and DeFi has exploded in growth. And so that's why we've seen stable coins take off. We haven't really seen stable coins be utilized yet as a medium of exchange. Now, I am open to the possibility that will change. And I think certainly when you look at this consortium, that's what they're getting at. And this is, and I think Austin put in the PWG report here into the chat feature. And so just by way of background, the President's Working Group on Financial Markets has been around for a long time. And it consists of the Treasury Secretary, the Fed Chair, the CF Commodity Futures Trading Commission Chair, and the SEC Chair. And in this instance, they did a stablecoin report, and they brought in the Comptroller of the Currency and the FDIC. And they were very clear in terms of the risk that they were worried about, which was if these things take off as a widely used medium of exchange, there's the potential for a traditional bank-like run. Okay, so again, stable coins, how are they stable? Well, they have a reserve. Traditionally, they have a reserve of fiat-denominated assets, and that's what makes them trade, one for one with the dollar. Well, that reserve can be dollars in a bank account somewhere. It could be Treasury securities. It could be corporate bonds. In some cases, we don't know. Tether is notoriously opaque with their reserve composition. So, what were to happen if, let's just say Tether, we'll stick with Tether, if holders of Tether were to have some concerns about the value of the reserves, and we're thinking, well, geez, this Tether might not actually be worth $1. I better get rid of it now. I better sell it now or redeem it now so I can get my money out. Because if everyone tried to redeem their Tethers at the same time, they would have to liquidate their reserve, and the value of the reserves, wouldn't be big enough or sufficient to pay out all Tether holders one for one. This is exactly what if anyone watched It's a Wonderful Life over the holidays, this is what a bank run looks like, right? We all know that if you have an account at the Bank of America deposit account, if every Bank of America depositor showed up, or went online at the same time and demanded their money back, Bank of America doesn't have dollars in a vault somewhere to pay us all back, at par. And so we have things like to correct that, like deposit insurance, right? To prevent people from bank run, from running, right? I know that I'll get my money back if I'm below a certain threshold. Banks have access to the Federal Reserve as a lender of last resort, so that the Fed can inject liquidity into the banking system. And these things control for for the run risk. Okay, it's still there, but they're controlled. Well, of course, none of that applies to stablecoin issuers, right? They don't have access to the Federal Reserve lender last resort. They're not insured, and that was really what the Treasury and the President's Working Group report called out. And so the solution, in their mind at least, is to require all stablecoin issuers to become banks, to bring them into the banking sector. Now, I know a lot of crypto folks weren't happy about this. I actually have some critiques about it. But again, going back to your example, well, if you're already a bank, hey, you're good in the eyes of the regulators, right? And with this consortium, it's almost, it sounds like they're kind of mutualizing losses a little bit too, Jimmie. So I'd be curious to hear, kind of how the regulators will consider this, almost like a
I think it'll be,
source.
I think it'll be interesting to see how it moves forward. And I know we only have a couple of minutes left, but I would challenge. One of the things that I would like to see is maybe for those of you who are in the economics and finance space, I'm thinking of you, Sunshine. Diamond Dybvig, Doug Diamond and Phil Dybvig modeled bank runs. This is years ago. I'm thinking 83. They came out with their bank run model, something along those lines. I think this is perfect to maybe call up Phil Dybvig and say, hey Phil, are you ready to start working on something a little bit different? He's always after me about new things. So maybe it's time to give him a call and say, hey, maybe we need to do this. Look at what does a stablecoin bank run look like? A stablecoin run look like? But I do think that it's a interesting thing. It's something I'd love to take up with you at our next time. But now with our since we have to close out here, I'll ask you. You got 30 seconds of wisdom left.
Oh man, you just put me on the spot here.
Well, that's what I do.
I think obviously, Jimmie, my main focus is on financial regulation. That's kind of what I teach and research about. And that's also something that is frustrating the crypto community. And so, maybe we could just make some 2022 prognostications here. I actually think the status quo is going to prevail when it comes to crypto regulation. We all know we have a dysfunctional Congress. We're heading into the midterms here. The crypto, right? Even the stablecoin, report that I mentioned from the President's Working Group. Well, their recommendation would require congressional action. That Congress would have to pass legislation requiring stablecoin issuers to become FDIC insured banks. That's not high on anyone's priority list in Congress. So. I think the status quo is going to prevail for the time being when it comes to crypto regulation. And I actually think the crypto industry is just fine with that, despite all of their frequent complaints and wanting, we just want regulatory clarity and certainty and this and that. The patchwork quilt of crypto regulation has actually created sort of legal gray areas where innovation has been allowed to sprout, frankly. And so, I think that, that's going to continue for 2022 and beyond.
I think that, when I think about the year to come, one of the things, obviously, I would love to see is more institutional use of NFTs, kind of in the way that we've done it with certificates and diplomas, other sorts of utility type mechanisms. So that's my hope for the year. I would agree with you in the malaise in the political sphere. I think that the idea of more regulatory guidance is probably not coming. Maybe some really peripheral things, but I don't see any sort of sweeping changes coming. I again would invite any legislators to give me a call. I'm happy to talk to them. The last thing I want is any sort of regulation done in a vacuum. And with that, I think we need to wrap it up. Lee, it's always great talking to you. We need to get together. We're both here on campus. So it's we can once the snow melts, we can walk down the street. All right,
good,
great.
Good to see you.
Thank you, everybody. Have a good afternoon.